Since we've bought and sold the same stock, our position is completely hedged and the risk of the stock price movement is minimized.
You're not essentially taking a call on the direction of the market. You're just taking advantage of the pricing inefficiencies.
Yes, volatility does help arbitrage funds. It would give more opportunities to the fund manager to take advantage of the differentials in the cash and futures market. They're not risk-free.
Hello and welcome to a special conversation by Mint, where we decode key financial instruments to help you make smarter investment decisions. In this episode today, we shine the spotlight on arbitrage funds, a category that often comes up when we talk about lower risk investing or short-term parking of funds. But what exactly are arbitrage funds? How do they work? And more importantly, are they the right fit for your portfolio? To help us understand this better, I'm joined by Rukun Tarachandani, who is part of the equity fund management team at PPFAS Mutual Fund. He's someone who brings with him a wealth of experience in both equity and derivatives, and he's here today to help us demystify this instrument. Hi Rukun, thanks so much for joining us today. Let's start with the very basics. What exactly are arbitrage funds? Because that word arbitrage itself may be alien to a lot of retail investors. So let's begin with what exactly are arbitrage funds.
Thank you, Mubina. Thank you for having me here. I'll start by explaining what a typical arbitrage transaction looks like. So in a typical arbitrage transaction, what we do is we buy a stock in the cash market and simultaneously we sell the same stock in the futures market. In effect, what we're doing is we've bought the stock and we've agreed to sell it at a higher price in the futures market. Since we've bought and sold the same stock, our position is completely hedged and the risk of the stock price movement is minimized. So arbitrage funds generate return by capturing this difference between the cash market and the futures market. They do not generate returns by taking a directional view on the stock price. An important point to note here is that arbitrage funds are considered as equity-oriented funds from a taxation perspective. So for investors in higher tax brackets, these would be more tax efficient versus other cash management or other avenues for cash management.
So basically, you're not essentially taking a call on the direction of the market, whether it will go up or down. You're just taking advantage of the pricing inefficiencies.
Exactly. So your return comes from the cash price and the futures price converging on the expiry date. So the differential between the two, it does not come from what happens to the stock price over that period. So arbitrage returns or arbitrage spreads are a function of a couple of things. They're a function of what happens to interest rates in the economy, market volatility, market sentiment, and the supply and demand of cash and future in the cash and futures market.
So let's talk about volatility, because that's one factor that you mentioned. And I mean, let's face it, it's an inevitable part of markets, having a volatile sentiment in the market. Would I be correct in saying that arbitrage funds perform better in volatile markets?
So all else equal, yes, volatility does help arbitrage funds, because when markets are volatile, it would give more opportunities to the fund manager to take advantage of the differentials in the cash and futures market, because they would be higher during volatile markets. Having said that, other factors also play into it, like interest rates in the economy and market sentiment. So if market sentiment is bullish, arbitrage spreads tend to be higher. But if market spreads or market sentiment is bearish, the spreads will be weaker.
Let's talk about how arbitrage funds would compare with other short-term investing options, because as we understand, arbitrage funds are also good for that short to medium-term time horizon investors. So comparing it with other similar products would mean perhaps, say, a fixed deposit, a liquid fund, or anything in that category. So how would you compare an arbitrage fund with other funds in the short-term, medium-term category?
So historically, arbitrage fund returns have been broadly similar to what liquid fund returns have been. Now, one can't predict what would happen to spreads in the future, but historically that's been the case on a pre-tax basis. On a post-tax basis, as I said, they are more tax efficient for investors in the higher tax bracket. Having said that, they are also a bit more volatile than liquid funds or other debt funds, especially on shorter time frames like daily or weekly returns for an arbitrage fund would be more volatile. And hence, an investor while investing in these funds should have a time horizon of at least 3 months before investing in them.
Okay, yeah, that was actually going to be my next question, that who should actually consider investing in arbitrage funds? So, okay, you mentioned that the time horizon should be around 3 months. What are the other characteristics of an investor who would stand to gain from investing in an arbitrage fund?
Sure. So the time horizon should be at least 3 months. The longer, the better, because the volatility tends to average out over that period. Investors in the higher tax brackets, for them, the tax efficiency would play a bigger role for arbitrage funds versus other debt funds. So investors in higher tax brackets who want to park their funds for a period of 3 months or more, for them, this is a fund category that they can consider. Another area wherein arbitrage funds can be very useful is for STPs. So just like an investor can park their surplus funds in a liquid fund and do an STP to an equity fund, the same way they can park their surplus funds in an arbitrage fund and then do an STP from there to an equity fund of their choice. The investor should keep in mind that arbitrage funds might have exit loads. So the STPs should start after the exit load period for the arbitrage fund has ended.
Okay, let's talk about the risk element, because the way you're describing it, you know, your purchase price is fixed, you've more or less hedged what you are exposed to also. So it seems like it's, I mean, you know, virtually there would be no risk. So again, correct me if I'm wrong. What's the risk element in arbitrage funds?
Yeah, so absolutely, they're not risk-free. So the risk essentially comes from the fact that arbitrage spreads can expand or contract. Okay. And this expansion or contraction, as I said, depends on a couple of factors. One is interest rates. So if interest rates, typically if interest rates come down, arbitrage spreads come down. And if interest rates expand, arbitrage spreads expand. Second is market sentiment. During bullish markets, arbitrage spreads typically tend to be better than during bearish markets. And again, as we discussed, market volatility. And finally, the demand and supply in the cash and futures market. So if a lot of capital is chasing arbitrage opportunities, the spreads will tend to be a bit lower. Now, what this does is that because of this expansion and contraction of spreads, NAV of arbitrage funds, which will be a bit more volatile than a liquid fund or other debt funds. So again, going back to our previous discussion, investors should have a time horizon of at least 3 months.
So let's talk about the scenario today. If somebody is considering and looking at the environment around us and all the interest rate scenarios, so on and so forth, what should investors keep in mind if they want to consider arbitrage funds today?
Sure. So one of the things that investors should consider or have is clear expectation that these funds are not tracking equity markets, and consequently the returns from these funds will not be like other equity oriented funds or equity linked funds. So that is one. Second, I think a very important factor while considering investment in these funds is that investors should do a careful due diligence of the debt portion of these funds. So in a typical arbitrage fund, 65 to 70% is invested in arbitrage opportunities. The rest is invested in debt securities or debt mutual fund schemes. Now, in order to generate a higher return, a fund manager can theoretically take a higher duration risk or credit risk. So an investor should do careful due diligence to ensure that no undue duration, that they are not exposed to an undue duration risk or credit rate risk.
Okay.
So these are the two important factors that an investor needs to evaluate.
Okay, that's very interesting. So that 35% that's there, that's where the fund manager could look at to strategically, taking on a little bit more duration or credit risk. So investors should evaluate that portion and really read the fact sheet for more information on that. So let's understand, PPFAS's strategy around arbitrage. What's it looking like for you all? How are you all managing the arbitrage portion? And might as well get in your opinion on the debt portion as well of your fund.
We believe that an arbitrage fund While investing in an arbitrage fund, the most important factor for an investor is the safety and liquidity of capital. Consequently, these are the things that are at the forefront of our investment decision making. This means that when we talk about the debt portion, we are very conservative with duration risk and credit rate risk. We are managing that portion very conservatively. When it comes to the arbitrage portion, we have a very diversified set of positions. So one particular position, the spread expanding or contracting in one particular position does not unduly influence the return of the fund over a short period of time.
All right, very interesting indeed. I think with that, we've clearly understood what exactly are arbitrage funds. I guess the name can be a bit overwhelming, especially for retail investors, but it seems pretty clear. And thank you so much for joining us today to clarify all of that.
Thank you, Mubina. Thank you.
We hope this conversation helped you understand arbitrage funds a little better, their workings, their purpose, and where they fit in your financial journey. To explore more such insights, stay tuned to Mint. Until next time, thank you for watching.